Corporate finance practice problem using Onenote. Warrant exercise and rate of return calculation. Get ready, it's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1927 Warrant Exercise and Rate of Return Calculations tab. Also note, when using Onenote, take a look at the immersive reader. Our presentations will be down in the text area as well with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculation in the blue area to the right, and on down below. We're looking at the warrants, considering what would happen if we were to exercise the warrants in the future and calculating the gain and rate of return on it. So we have our warrants here. We have the number of warrants being 90 warrants. We have more than one warrant we're talking about at this point, 90 warrants. Years into past purchase, they were purchased, in other words, a year ago. The cost per warrant, they cost us $25 per warrant. The exercise price, meaning we can exercise the warrant and buy the stock at the 34 shares, and with one warrant, we can buy 2 shares. So if we have one warrant, we can buy 2 shares at the exercise price of the $34, that typically being below then the price of the stock. Then we're going to assume that a year later the warrants expire. At that point in time, we would like to exercise them. So we're going to exercise the warrants then a year later. No speculative premium left, meaning there's no amount that's going to be over and above basically the intrinsic value of the warrant at that point in time. And then the common stock price at that point is going to be $61. So let's calculate the purchase price of the warrant. For the purchase price, we're simply going to be taking the number of warrants that we're going to be purchasing, the 90 warrants, and we purchased them for $25 each a year ago. That 90 times the 25 gives us the $2,250 for the cost of the warrant. Then 1 year later, we're going to imagine that we exercise the warrant. So we're going to exercise the warrant, and the exercise value then being the number of warrants, 90 warrants, times 2, because each warrant allows us 2 shares of common stock at the exercise price. That means that we're going to have 180 shares if we exercise all 90 warrants. The stock price is $61 1 year later, and the exercise price to us, meaning the price for us to exercise the warrant, was $34. So we can exercise or pay $34 to buy the warrant instead of the stock price at the current time period, the 90 or the $61. The difference between the two would be the $27. And if we take then the number of shares, the 180 times the difference here between the stock price and the exercise price, basically the value that we're getting as we exercise the warrants, that would give us the $4,860 for the value, the exercise value. So now we want to consider the profit. If we consider the profit after we exercise them, we have that value that we have received now, us having these warrants at an added value to us of the 4,860, which again is the stock price minus the exercise price, giving us that value. And we're going to take that times the warrant total cost. The cost of the warrants being, we calculated up top at the $2,250. So the difference there is going to give us basically a profit or gain on the warrants there of the $2,610. So then we can think about what the percentage profit would be, and this could be a useful calculation when we're trying to compare and contrast, as we'll do in future problems, the potential gain or loss on, say, the warrants versus the stocks themselves. So we can then take our profit, which is the 2,610, and the warrant total cost, what we purchased the warrants for, the 2,250, divide them out, and we get our 116. Let's just plug that last one in the calculator here because the calculator's bored. I'm going to pull out the calculator. 2,610 divided by the 2,250 is going to give us 1.16 or 116% on the profit.